It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. The yen and South Korean won strengthen as traders factor in chances of intervention. The yuan also getting jaw-boning support from the PBOC. More Fed officials signal a delay to rate cuts. Cleveland's Loretta Master wants to see more data, while Governor Bowman thinks that progress on inflation has stalled. Also ahead, we put the currency and inflation story together to go shopping. Find out why Japan tops the destination list for luxury bargain hunters. Plus, a great lineup of guests. M&G Investments Director for Fixed Income Investments is up first, and later we speak exclusively to the CEO of one of the leading renewable energy companies in Southeast Asia, ACEN. Let's get you to Markets Asia, extending gains at session highs right now. Even after the U.S. closed in negative territory's longest losing streak this year, calm, somewhat returning the MSCI Asia-Pac Index up more than 1% right now. Of course, it is about that strong dollar, which is taking a breather right now. It is down about 1/10 of 1%. Traders recalibrating yet again Fed rate expectations. Asian FX, of course, getting a lift today on the back of that weaker dollar story. Yen getting a breather, 154. Still the yen at the lowest level in more than 30 years. Take a look where we are in terms of Chinese yuan. 724.34 is the level we're looking at right now. Now let's deep dive into markets with Paul Dobson, Executive Editor for Asia Markets at Bloomberg News, and Pierre Chartres, Fixed Income Investment Director at M&G Investments. Paul, let's start with you. It is about FX. It is about the strong dollar, and we saw how the finance ministers of Japan as well as South Korea met with Yellen. Just how important is that meeting?
Yeah, I think that that's a significant moment because Asia was meeting with the US and expressing clearly dissatisfaction with the current exchange rate and the pressure on their currencies. And if you listen to Kanda's comments, he says we've got serious concerns, and he says, I want to emphasize that serious concerns. And I think the takeaway that they got from that meeting was a tacit acceptance from Janet Yellen that if that pressure continues to build, then there's a green light for them to intervene in the market. So South Korea and Japan probably would have felt quite pleased with that outcome. And what we're seeing today in the currency markets in response to that, as you were describing, is a little bit of that pressure coming off. Traders a little bit more cautious given that backdrop, and so allowing those currencies to strengthen a little bit of dollar weakness coming through. So I think that that was quite an important meeting. But of course, it may be just a temporary respite. Who knows how long it's going to last, depending on how long those Fed expectations get pushed back, or whether a cut comes back into the equation for earlier in the year.
And Pierre, Fed expectations. Traders keep recalibrating and recalibrating. Where are we with that?
Yeah, so you're absolutely right. I mean, the outlook still remains dependent on inflation, and we've had a decline in inflation at the end of last year, and this first quarter of 2024, we've definitely seen a resurgence in those inflation expectations, and that has gotten the markets quite worried for obvious reasons. In our view, this is a pause in the disinflationary trend, and over the long term, with monetary policy where it is in the US, we still think inflation will gravitate very slowly, and it's taking more time than initially expected, of course, but back to the Fed's 2% target.
What would, I guess, fully price out rate cuts this year? Because we've gone from 7 to 3 to 2, perhaps 1 and none.
Yeah, so we're almost there. You're absolutely right. I mean, the movements have been quite dramatic from, again, November of last year to now. We've gone kind of completely full circle. Higher inflation would essentially price out the remaining 2 rate cuts. Maybe Chairman Powell hinting at rate hikes would spook the markets to some extent. But in our view, as we've said, we're not there yet, and the Federal Reserve is going to be patient and keep interest rates at current levels for as long as they need to.
And all the same, Pierre, I think that your position is that you're quite confident in long duration plays and attractive looking corporate bonds. So what's the calculation there, that at some point the Fed is going to start cutting and that's going to be good, or is it just simply a yield play that you're looking at?
Yeah, it's a combination of those two factors. From a valuation perspective, 10-year U.S. Treasury yields at 4.6 are relatively attractive in our view. If you look at the last 25 years, the ceiling's been 5%. So your risk reward, in our opinion, is quite attractive. If there's a soft landing, then you can see those yields gravitate slowly downwards maybe, or even if they go sideways, it's not a bad thing for fixed income markets. And then another benefit of fixed income is, of course, those diversification benefits are back with interest rates at 5.5%. If there is a hard landing, geopolitical risk escalates somewhere, you can expect lower yields, and that would be positive. So if you take all of those outcomes and probability weigh them, we do see value in having long-dated exposure in the fixed income markets today.
Would you say that treasuries have become a tactical play, given where yields are right now?
We would say that right now they are attractive, yes, definitely, given that, as you said, the markets are now pricing in only 1 or 2 rate cuts by the end of the year. We think, as we said, monetary policy is restrictive. Monetary policy works. Everyone has kind of given up on the fact that monetary policy does work, but in our view it works with long and variable lags. Of course, the U.S. economy has been very resilient, more resilient than outside of the U.S., but over time, as we said, we do expect growth to revert back to trend, and those kind of demand factors in the U.S. subside to some extent.
We talk about how traders are hedging themselves against risk. Are we clear what that risk really is? Is that inflation? Is that slowing growth? What are you seeing?
So I think, well, we think right now that the risk is clearly inflation, right? That has probably what has markets moving the most, and that's kind of been the most anticipated data point for some time now by the markets and widely expected. We've had some false signals as well. For example, CPI kind of being in disconnect with PCE, core PCE in the US. So sometimes it's a little bit hard to get a read, and we've gone, as I said, kind of in different directions at different points in time. But for us, that's the main risk, a resurgence of inflation, similar to what we saw at the end of 2021, 2022, is the main risk for bond markets at current times. There are other risks, of course, and again, in our view, we're still relatively constructive, given where valuations are today. Even if inflation does continue to surprise on the upside, your downside for bond markets is a lot less because yields are already quite high.
Given what you're saying, it would make sense if you were overweight US markets, but is that right? And are there other parts of the world where you find particularly good, attractive opportunities right now?
Yes, absolutely. So that is one feature of the bond markets today, which is maybe a little bit different to what we've had over the last 10 years, is that fixed income is attractive really from a global perspective. And you look at the UK, you look at Europe, government bond yields, credit, high-quality corporate bonds remain attractive in our view. So it's important to stay globally diversified. As regions maybe desynchronize, as we continue to expect in 2024, maybe with the ECB, the Bank of England cutting before the Federal Reserve, that will also open up additional opportunities. So in our flexible fixed income portfolios, we definitely have a global approach, and we try to really take advantage of opportunities wherever they may be.
And we talk about how credit markets are priced for perfection. What are the risks out there? And, how do you factor in geopolitical risks right now in the Middle East?
Yes, so when we say that, it's typically we look at corporate bond spreads, which are quite tight versus history. So your upside, to some extent, is capped, and then if there is a recession or if there's a bout of risk aversion, like we saw over the last few days, then you can see those corporate bond spreads widen quite a bit. So we think it's important to remain relatively defensive within credit, maybe not swing for the fences, given where valuations are, given where we are in the monetary cycle. Be patient in corporate bonds, wait for better entry points in the future, because, as you said, those geopolitical risks, which are very difficult to price for, aside from being very well diversified, they might prop up again and give investors a better opportunity to go into the credit markets in the future.
How about in terms of opportunities in this part of the world?
Yeah, so within Asia, we do find value in a similar way. Investment-grade corporate bonds, in our view, remain attractive. Just those high U.S. dollar yields make it an interesting carry play. And then, as you pointed out, the U.S. dollar has been quite strong in recent weeks, driven by those interest rate differential differential gap that is increasing. But as we say, in our view, over the medium term, U.S. economic growth is going to normalize, inflation is going to normalize. So maybe that expensive valuation of the U.S. dollar will come down to some extent. The U.S. dollar might depreciate in the medium term. So there will be opportunities to add to Asian currency like the Malaysian ringgit or the Indonesian rupiah, in our view.
And just to put you on the spot a bit, Pierre, and apologies for that, but on a total return basis, I guess global bonds are down more than 3% this year. So far it's not working all that well. Equities up 10% in the first quarter. Is it just a question of a waiting game, or, when does that diversification benefit start to really feed through to returns, basically?
You're right. This year, 2024, has been more difficult for bond markets. To some extent, it's a reversal of the strong price gains that we saw at the end of 2023. In our view, we have a valuation approach. So as U.S. Treasury yields, for example, continue to rise, as government bond yields continue to rise, we would be really quite tempted to gradually scale in to fixed income, to increase our exposure. Right now, sentiment seems quite bearish on bond markets, but if you take a contrarian approach, that's actually probably a good indicator for the asset class on a forward-looking basis.
We talked about how the Fed is pushing back its rate cut expectations. How are you assessing the challenges faced by central banks in Asia in particular? We've seen how, for instance, Bank Indonesia was forced to intervene to lift its currency.
Yeah, so I guess in Asia, there's the additional challenge that a lot of central banks are Federal Reserve dependent and are waiting for maybe the U.S. Central Bank to make the first move. On the other hand, in many parts of Asia, we haven't seen the same inflationary pressures, the same demand side pressures than in developed markets. So in some way, many central banks in Asia are actually not in such a bad position, and we would include Japan there, where the rate hikes have been very limited so far.
Earlier you talked about the opportunities out there in the markets. What's the best conviction call out there? What would do best by the end of 2024, you think?
So within our global flexible strategies, we still think buying long-dated government bonds or long-dated corporate bonds is really the way to go. If you take a 12-month view, where will interest rates be in 12 months? Where will 10-year U.S. Treasury yields be in 12 months? Of course, we're very reactive and we will adjust our position. But in our view, the next move is probably lower. And if yields do continue to increase, then we will gradually increase our duration.
So, and to kind of go along with that theme a little bit more, what's your best bet for when the Fed does start to cut interest rates?
So, central banks all over the world have said that they will be patient, that they are in no rush to start cutting interest rates, that they would rather cut rates too late rather than too soon. So if you look at the Federal Reserve, I think June is looking a little bit premature, in my opinion. Even July, I think, might be, depending on the data, a little bit too soon. But so I think we'll have to wait Q3 or Q4 before we see the first rate cuts in the US, maybe earlier in Europe.
A waiting game, right, Paul? That's how we started the year. That's how we'll probably be talking about middle of the year as well. Bloomberg's executive editor for Asia markets, Paul Dobson, and Pierre Chartres of Amin Investments. Just something to tell you about. We have China's Central Bank Governor Pan Gongsheng meeting with Jerome Powell on the sidelines of the IMF meeting in Washington, D.C. The pair discussed the current situation of the U.S., China's economy as well as monetary policy and financial stability. Again, the two, Pan Gongsheng, the governor of PBOC, and Jerome Powell meeting on the sidelines of the IMF meeting in Washington, D.C. Still ahead, our exclusive interview with the president and CEO of Philippine renewable energy firm ACEN. We get Eric Francier's industry outlook and insights on the company's expansion plans later this hour. But first, TSMC releasing its full first quarter results in just a few hours. We discuss why analysts are expecting a rebound in earnings growth. That's coming up next. Keep it here with us. This is Bloomberg. keeping an eye on Asian chip makers as we count down to TSMC's earnings later today. It is expected to report a rebound in earnings growth after demand for chips used in AI development helped to propel the bottom line of the company. Some nerves in the market as well. ASML saying orders tumbled in Q1, China sales likely to be hurt. TSMC up 0.2% gains too for Samsung Electronics, SK Hynix, as well as SMIC currently up almost 2%. Now, TSMC's capital spending plans will be a key focus for investors in those results. That's after ASML posted orders short of expectations, as TSMC and other Asian chip makers held off on buying equipment in the latest quarter. Bloomberg Intelligence senior analyst Robert Lee is with us. Rob, do those ASML results give us any insight, any indication of what we can expect from TSMC today?
Very good question. ASML, though, has an enormous order book that stretches out multi-years. So the surprise we saw last night was that their EUV orders in the current quarter, or the quarter they've just finished, were lower than expected. However, those orders would be due for delivery, really post this year. So I don't think it has any real bearing on TSMC's quarter that will be reported later today, or really for TSMC for the rest of the year. However, there is a question mark as to the sustainability and the outlook of the demand environment, post this year. So I think that's just something to sort of file away and, and bear in mind as the year progresses.
Rob, I'm looking at the estimates for TSMC. Net income estimate, 214 Taiwan dollars. Can TSMC beat expectations?
Yeah, I think as yourself and your viewers know, Taiwanese companies report monthly sales. So we actually know what the Q1 revenue number was, and it was slightly ahead of the mid-range of their guidance. We also had the earthquake, if you remember, a couple of weeks ago, and the impact from that seems fairly negligible on the company. So those are two positive factors. Obviously, the story has been driven by AI. I don't need to go through that. It's well known. So I think overall with the revenue beat, or revenue coming slightly ahead of the mid-range, as I said, then yeah, the market is expecting a decent set of numbers. But then tying back to what you said a moment ago, there are potential question marks on the longer-term horizon, given obviously ASML, and also with the weakness we're seeing from Apple, because Apple, on our estimates, accounts for roughly 20 to 25% of TSMC's revenue. So NVIDIA will remain in the driving seat. I think overall, the outlook remains good, but there are these question marks on the medium-term horizon with Apple and also the ASML side.
Given these question marks that you're talking about, Rob, how does Q2 and the rest of the year look like? If you were to look into the crystal ball, what will you see?
Well, I guess that's what I'm paid to do. So I think, again, the market, looking backwards, it's unlikely we get any major surprises out of Q1. And I think Q2, from where we are at the moment, again, looks to be a pretty solid quarter for them, driven by NVIDIA, driven by AI. But again, let's take a quick step back. Roughly 14% of TSMC's revenues come from the auto sector. That's mainly driven by EVs and obviously mainstream automotives. We are seeing weakness come through on that side, particularly on China EVs. So that's a question mark. Apple, as I've mentioned, 20 to 25% of growth. So we are seeing incremental weakness come in there. That's an additional question mark. AI demand remains robust. We all know that story. But I think there are potential signs of incremental weakness coming through. And also, given with the stock trading at a key technical level at the moment, given the backdrop of weakness we're seeing in markets, I think this company's really got to deliver earnings outlook that is above market expectations to potentially drive the stock, higher from here. I think that is a pretty rational view from where we stand.
We have a Bloomberg scoop, Rob, that Micron is set to get about $6 billion in grants from the U.S. government to build factories there. It does sound like anti-competition to me.
Yes, I would say, it's a great scoop that the news colleagues have got. I wouldn't say it's massively surprising because Micron and Intel are two of the few remaining semiconductor companies that not just design their chips in the US, but actually fabricate and produce them domestically. So given what the US is trying to do in the geopolitical environment at the moment, you've got to look after your own. Therefore, it's unsurprising, I think, that Micron is getting these grants. So will it change the competitive dynamics at all? Micron's main competitor is really Samsung and Hynix in South Korea, and they're the industry leaders at the moment. So it should help bolster Micron's position and medium-term outlook. But DRAM and NAND flash, without going into the detail, is a notoriously volatile market. And I think, Micron's near-term outlook is more determined by the balance of supply and demand in the market rather than any US grant. But it is positive for sentiment for them.
6 billion ain't too shabby. Bloomberg Intelligence, Robert Lee. Thank you. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Here are some top stories out of China we're following. President Biden has called China xenophobic, highlighting the Asian nation's economic woes during an election campaign stop in Pennsylvania. While overall relations between the two nations have stabilized of late, tensions are growing over Chinese investments in manufacturing.
They've got a population that is more people in retirement than working. They're not importing any. They're not bringing. They're xenophobic. Nobody else coming in. They've got real problems.
China's Commerce Ministry has blasted a Biden administration plan for a formal review of its maritime, logistics and shipbuilding sector. The U.S. Trade Representative's office announced the investigation after a petition from 5 major union groups. Beijing says the review wrongly frames normal trade and investment as harmful to the U.S. and is driven by domestic politics. The Chinese yuan is accounting for a growing share of international payments. Data from SWIFT shows the portion of yuan transactions rose to 4.7% in March, the highest since a new baseline was created in July. Meanwhile, the euro's share continued to decline, dipping below 22% last month. The yuan has been the world's 4th most transacted currency since November. And here's a look at Mobile Health Network Solutions, a Singaporean telehealth startup that is the hottest US IPO so far this year, with more than 350% rally. The company's market capitalization has ballooned to around $650 million, and that's despite reporting a loss in its most recent fiscal year. Take a look at that, a massive 350% upside. We're also keeping an eye on Aussie miners. Santos currently down 0.4%. That's on the back of Q1 production falling short of estimates. Also, BHP Group in focus, iron ore production rising 3% in the year's first 3 months. This is, of course, the world's biggest miner, shrugging off heavy rainfall at its Western Australia projects, along with dwindling demand in China. BHP Group up more than 2%. Well, up next, Philippine renewable energy firm ACEN will be joining us for more. Keep it here with us. This is Bloomberg. Shanghai, welcome back. China markets just heading to lunch, and we have the CSI 300 index reversing losses, now up 0.6%, though some like Amundi say most clients still avoiding China despite cheap valuations, trading 9 times 12-month forward earnings estimate. MSCI China, by the way, up about 10% from a low that we saw back in January. CSI 300 index up 0.6%. Gains too for the China Shanghai Com as well as Shenzhen Com. We're taking a look at where the yuan is trading right now. 723.53 flat versus the USD. Of course, the USD pretty much in negative territory as we speak. Well, China heading to lunch. We have Japan coming back from lunch. Let's do a check-in on how Japan and the rest of Asia is faring. Avril Hong joins us more here in the Lion City. Hey, Avril.
Hey, Has. Yeah, we're looking at some calm returning to Japanese stock markets today after multiple days of losses. No thanks to that higher for longer Fed narrative. And today we're seeing the Nikkei, the topics, they're managing to clock gains. Even some of the big movers from earlier in the session, like the chip-making related stocks, which saw earlier losses, no thanks to ASML and its orders flashing flashing a warning sign about chipmaking demand potentially. Some of them, the likes of Tokyo Electron, managing to pair declines from earlier in the session. But let's take a look at what we're seeing among currencies, because obviously, given how this Fed narrative is playing out, that's going to be a bit of a headache for Asia's central banks. We are getting the sense that the calm in the stock market might be short-lived, given how these US short-dated rates are likely to remain elevated. We're seeing the greenback, as you mentioned a short while ago, supported. Today, we're seeing that recovery is still underway in Japanese and Korean currencies. We did get a joint statement from the US, Japan, South Korea that's spurring intervention bets. The PBOC also coming in with some jawboning, but Philippines also something that we're focusing on. We've heard from the Deputy Governor of the Philippine Central Bank speaking in Washington, saying that inflation in the second quarter is likely to remain elevated before easing. And separately, the Governor of the BSP has said that any easing is likely to come push back in the later part of this year, even into next year, Has.
Well, that's right. It's higher for longer environment, not great for Asian currencies. We talk of the Philippine peso. It fell past that very closely watched level of 57 per dollar for the first time since November 2022, as expectations that the Fed will delay interest rate cuts weigh on risk assets. Let's find out how a weak currency is affecting Philippine companies with overseas operations. Our next guest runs a power business of listed conglomerate Ayala Corporation. Eric Francia, President CEO of ACEN, joins us exclusively. Eric, good to see you in my city. Now we talk about how there's a lot of weakness in the currency. How is that impacting your businesses? You have businesses pretty much across the region.
Yes, well, as you said, Haslinda, we're pretty much diversified. We have businesses in Vietnam, in Australia, India, and Indonesia, and a little bit in the US. So with this diversification, it actually helps us manage the volatility, including currency volatility. As you know, as a de facto export business, that strengthens the value of our international business as and when we repatriate back to the Philippines. Although, of course, that's not actionable at this point because we're a growth company and we typically reinvest at this point any operating cash flows into expansion and growth. But overall, obviously, with significant exposure in the Australian dollar, US dollar, it is good hedge against the peso weakness.
Is there concern about debt, US-denominated debt that you may have?
Not necessarily, because our policy, our internal company policy, is to match the currency of the revenues with the debt. So we have a perfect match either through a natural matching or hedging. So we don't have exposure in terms of currency mismatch when it comes to debt.
Of course, we know that when it comes to your renewable capacity, you have a big ambition of getting to 20 gigawatts. Where are you with that, and what's the plan to ramp it all up?
Well, we're now currently at around 5 gigawatts of operating and under construction capacity. If you count the projects that we have already signed agreements, but subject to conditions precedent, we're well above that, closer to 6 gigawatts. So it's a very strong momentum. We targeted 5 gigawatts by 2025, but we actually essentially achieved that 2 years ahead of schedule. There's good momentum. Obviously, with the uncertainty and volatility around the world, we need to calibrate the growth. Doesn't mean that we will necessarily slow down, but it's more of a calibrated approach. For example, with rising interest rates, you just need to plan ahead that as and when the rates taper, that's when you step on the gas pedal again. So that's the theme. Some of our shovel-ready projects, if you will, we may just need to exercise a little bit of patience. Anywhere, overall, we are ahead of plan, so we have the luxury of being more patient in terms of hitting the green go-ahead button.
How about in terms of your projects like the floating solar project? How is that coming along? How is that contributing to your overall targets?
Well, the floating solar in the Philippines is a huge one. We have 800 hectares on the lake that could enable 1,000 megawatts of solar. We've been experiencing a string of red and yellow alerts in the Philippines, as you very well know, the past few days. Much more capacity is needed. It does take time because it's a new technology. We are now in the process of going for the permits, getting the permits, and it's going to take time, but we will certainly get there. In the meantime, we're full speed ahead with expansions in some of our onshore wind projects and ground-mounted solar. And in fact, we're already operating today. We have over 500 megawatts of solar plant in the Philippines that was recently operational, providing a lot of much needed power to the grid. So especially during summer, because that's the peak production of solar. So it helps a lot in a very tight situation. But we need to roll out much more.
You talk about expansion within the Philippines.
Yes.
How about expansion, extending your footprint around the region? Are there plans to do that within the next 12, 24 months, for instance?
Yes, certainly. Australia is our largest market outside of the Philippines. So there's a lot of activity there. We just recently signed an MOU with Marubeni on a 200 megawatt battery storage because the country needs it. Australia, as they're forging ahead with the energy transition, you need to balance the intermittency of renewables with a lot of storage. Vietnam, we're doing a cross-border as well. We're involved in a large, the first and the largest wind project from Laos exporting to Vietnam. We're doing some expansion in India as well, which is a very large market. But obviously, Philippines remains our core. That accounts for 40% at least of our business, and there is a dire need for renewables expansion in the Philippines. So we're pretty much focused as well on scaling, accelerating the scale up in the Philippines.
Can you put a number to your expansion plans, both in the Philippines as well as overseas?
We're now at 5 gigawatts, and we still are targeting 20 gigawatts.
But in terms of investment money, funding that you're putting there?
Over the balance of the decade, we're going to look at 15,000 megawatts or 15 gigawatts will require about $15 billion of capital, of which 40% will come from the Philippines. So we'd be looking to invest around $6 billion of capital, at least in the Philippines over the next 6 years or so, or roughly about $1 billion of capex in the Philippines.
So all this will contribute to you becoming ASEAN's largest listed renewable platform, or?
That's the ambition, that's the aspiration, and I think we have a lot of momentum and getting strong support from our partners, from the banks, from financial institutions. So I think there's a lot of momentum for doing this renewables push.
Eric, we also know that you're doing some drilling. You're leading a consortium in the South China Sea. How is that coming along?
Well, no, we're not doing any drilling there.
But a unit of yours is leading a consortium?
No, we're not involved there. We do have a unit that has a oil and gas service contract, but given that we're renewables focused now, we're not putting any capital behind the drilling, but we're actively looking for the right sponsor to de-risk that, because as you very well know, the Philippines needs as much indigenous resource as it can muster. Malampaya is declining, but prime infrastructure is already doing the drilling program to expand and to extend Malampaya. There are other service contracts that are promising. Our subsidiary has one of them, but unfortunately, because we're renewables focused, we're not going to be de-risking that by ourselves.
Energy, of course, a big issue, as you said, in the Philippines. Where are we with how the Philippines is gearing towards its renewable transition?
Well, the Department of Energy definitely has set the right goals and policies in place, targeting 35% renewable output by 2030. We're currently at 22%. And further expanding to 50% by 2040. It's a large goal. By our estimation, we would need to construct new capacity of around 18 gigawatts of renewables capacity between now and 2030, and well over 50 gigawatts by 2040 to reach those DOE targets, as well as to address the growing demand of the Philippines, which is still growing at around 5% per annum. So it's a big task ahead, and that's why we are bullish and working hard to help reach those goals. One of the key constraints is transmission line, of course, and that's why we're working closely with the grid operator and the policymakers to ensure that this infrastructure is built. In our case, we have actually invested upfront quite a bit of transmission connection infrastructure to enable large-scale solar plants that can later on be incorporated with battery storage to make them more reliable and decrease our need for fossil fuel plants, which, by the way, back to the theme of foreign exchange, fossil fuel plants, for coal, for example, half of the cost of electricity is linked to fuel, which is quite volatile in terms of commodity price and foreign exchange. And gas is about 70 to 80% of the electricity price of gas is linked again to gas prices and forex. So to be able to really accelerate the scale up of renewables and battery storage, that will help us not only hedge in terms of energy security and less reliance on imports, but also fix the price. Because once you lock in, it's mostly capex. There's no marginal cost. There's no fuel to talk about. So it's a good balance, and hopefully the Department of Energy will create the policies to really push renewables and storage in the Philippines.
Are there measures that can be implemented to expedite, policies even, to expedite that transition?
Yes, absolutely. And I've been in Ecosperity here in Singapore, and one of the measures or mechanisms that we are piloting with the support of Monetary Authority of Singapore and the Rockefeller Foundation's Coal to Clean Credit Initiative is this notion of transition credits, which is a form of carbon credits, high-integrity carbon credits that entail the early closure of coal plants and the replacement with clean energy. So as I was explaining in the forum, the transition credits will help us accelerate further the retirement of the coal plant that we have influence on. This is 246 megawatts, to bring up the retirement from 2040 to 2030. But the responsible thing to do, given the tightness in the market, supply demand in the Philippines, is to replace that with clean, reliable, and affordable energy. So our clean energy solution will entail not only building the ample amount of solar and wind farm, but also energy storage. And that will be funded in part by the transition credit proceeds, because battery storage, as it stands today for that use case, is not economical. But with the use of transition credits, the thesis is it will make it economical and feasible.
Eric, great insights. Thank you for joining us today. Eric Francia, President, CEO of ACEN. Well, still to come, how dollar strength and lingering inflation are turning Japan into a paradise for luxury shoppers. Details next. Keep it here with us. This is Bloomberg. All right, welcome back. Let's do a check on Indian markets as it joins the trading day. Of course, we're seeing gains in Asia, unlike how the U.S. closed yesterday. Of course, we have India currently in positive territory in the first minute of trade. Sensex index up 0.3% gains for the other benchmarks, Nifty index as well as the Nifty 100. We're keeping an eye on Infosys, currently flat, Bajaj Auto, as well as HDFC, all expected to report earnings today. Mixed picture there, Bajaj Auto, HDFC in positive territory. Now, let's get to the Fed. Fed Chair Jerome Powell's caution on rate cuts this week amid persistent inflation is making things difficult for other central banks looking to ease. Let's discuss this with Bloomberg Analyst strategist Mark Cranfield. And of course, the situation has changed from when we kicked off the year.
It's very different. I can remember discussing it with you in December, just after Jerome Powell had sounded very dovish. And expectations were very high that we were going to have several interest rate cuts this year. Dollar was starting to get a bit weaker. Treasury market was on fire. How the situation has changed, the pushback, not just from Jerome Powell, but other Fed speakers as well, recognizing the fact that the data has just been very strong for them. So we've seen a reversal in so many things, and yet the stock market continues to do well. But in terms of the currencies specifically, you can see G7 people, there's this G7, the meeting going on this week in Washington. You can hear the concerns, especially from Asian central bankers and finance ministers. They're very worried about what the strong dollar is doing to their currencies, because they know they're in a very tight spot. They don't really want to raise interest rates to protect their currencies. They're really hoping for they're hoping that the United States would help them out a little bit by weakening their currency through the interest rate signal. But that's not happening. So that's why you're hearing, and Janet Yellen today has come out with the Japanese and the South Koreans saying that she has sympathy with them. And so effectively she's giving them a green light. If you want to go and support your currencies, we're not going to stop you.
So that's why the market's looking at intervention, especially for the yen, as well as the Korean dollar. Rising prices, strong dollar, also changing the world of shopping. And for savvy shoppers with a nose for a luxury bargain, Japan is proving hard to beat. For more, let's bring in Asia investing reporter Lisa Du in Tokyo and Bloomberg Intelligence senior analyst Ada Lee in Hong Kong. Lisa, let's start with you. I mean, we're seeing all kinds of deals in Japan. We know that the Japanese have been gravitating, descending on Japan to get those bargains. You got to wonder how long that will last.
Yes, definitely. I was just in Ginza the other week, which is, one of the luxury shopping districts in Tokyo, and it was full of tourists from the U.S., from across Europe, from across Asia, all hoping to get their hands on some luxury goods. They've discovered that basically with the yen being so low and with their ability to shop duty-free without tax, they're able to get lots of savings on anything from Hermes scarves to Chanel bags to Cartier bracelets. And it's certainly, I think for them, it's a very good sentiment right now because they're holding much stronger currency than the yen, able to shop.
That's right. And in terms of LVMH alone, I think it saw its Japan sales rise 30% when the other parts of Asia actually saw a decline in sales. And Ada, at the other end, we're also seeing big demand for discount stores minting billionaires in Asia. I mean, talk to us about it. And will this trend last?
Absolutely. So in terms, when you look at the LVMH and the luxury shopping, it is mostly for international travelers. But for the Japanese people themselves, when they're in that country, with the persistently high inflation that they're experiencing, it is quite tough on their wallet. So what we're seeing is some Japanese retailers actually refraining from upping the selling prices just because they're scared to scare people away from the shops. And with the inflation, people need to be mindful of, where they're spending. Are they spending on consumer staples where they need to, feed their families and also just keep a family running? Or will they have sufficient extra cash to spend on luxury? So it is one of these questions that we think, with these discounting stores, probably is going to stay for a bit longer because people are looking for more value for money.
Hi, Lisa. I've got a question about the yen. So obviously the weakness of the yen has attracted a lot of people, as you say, coming into places like Ginza. Do you get any sense that at which point maybe they wouldn't want to come to Japan? We see dollar yen around 154, but let's say we went down, say, to 130. Would that make Japan too expensive for foreigners?
To be honest, I feel like even at 130, it'd still be quite attractive because you're thinking about, how it was before the COVID, where dollar yen was about at 110. So right now it's at 30-year lows. They're getting almost a 40% discount compared to before when the yen was much stronger. Even if it went to 130, I do think that demand to come to Japan would still be quite strong.
And Ada, we're seeing a lot of competition from Chinese platforms, e-commerce platforms. How is that playing out?
I think that's always a tricky one to navigate because with the e-commerce platform, we are seeing a proliferation of cheaper goods for the people in the country. And in Japan, say for example, with the constraint in spending powers given the persistent inflation, we do think that people will increasingly utilize various platforms and various channels to get cheaper goods.
So, Mark, in the end, when you take a look at currencies, where do you think Asian currencies will be headed by year end if there is no rate cut? And increasingly, we're talking about no rate cuts for the year.
Well, the way in which the central bankers and the finance ministers are really stepping up their verbal intervention, it suggests that they are losing patience and that they're getting very close to drawing a line in the sand. The way that Janet Yellen speaks as well is not going to stand in their way. So we're probably reaching a point, even if the Fed doesn't change interest rates, somehow the Asian countries are going to take it into their own hands. What we may see is a few Asian countries at the same time buying their currency. That'll be quite effective. To see several move at the same time, traders would take notice of it. So we're probably reaching a point where they can't stand it much more. They're going to take it into their own hands. Once that happens, once they stabilize the currencies, you probably start to see some improvement. So you would expect Asian currencies will end the year in a stronger position than where they are now.
Lisa, you get the final question. I mean, I'm looking to go to Japan, of course, but we know that when it comes to luxe brands, they tend to equalize their prices. Are they likely to do that?
Yes, like you said, these big luxury brands are also quite savvy, and they do want to equalize prices globally to kind of prevent these luxury arbitrage opportunities. However, what you're seeing with the yen is that it is fluctuating. Keeps getting weaker. The volatility there's a lot of volatility. So if you are a very savvy shopper, you're here in Japan at the right time, holding quite stronger currency, you are able to score very good deals. One product, just to give an example, that we looked at was a Tag Heuer watch. Usually retails about $6,500 in the U.S. In Japan, you can get it for around $5,000 here. Getting savings of more than $1,000 here. So it is quite a good deal right now in Japan.
Yeah, and given how the Sing dollar has been pretty resilient, Mark and I will be on the next flight to Tokyo. MY strategist Mark Cranfield, Asian investing reporter Lisa Du, and Bloomberg Intelligence senior analyst Ada Lee. We thank you so much for playing with us today. Plenty more ahead. Keep it here with us. This is Bloomberg. The picture paints 1,000 words. Asia not tracking the U.S., extending gains instead at session highs as we speak. And dare we say it, calm actually returning. Traders recalibrating yet again Fed rate cut expectations. Asian FX also strengthening, reflecting the possibility of that intervention, particularly where we are in terms of the won up almost 1% versus the USD. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. This is Bloomberg.